Okay, folks, let's take a look at some of the charts of the major indexes and the sectors, the major sectors, because today was not a good day. Today is Tuesday, the 27th of August, and let's begin with, before we go to the charts, let's take a look at the economic data. Yesterday, we had durable goods orders that were released, a fairly substantial miss on the headline number, but then when you drill down to the durable goods ex-transportation number, you had a huge miss. You had an expectation of 0.6% increase. You had a negative 0.6%. Really bad call on those who made that call, and not good for the overall markets. But what did they do? They closed up yesterday, yes, off of the day's lows, no doubt, but they closed up. Then you fast forward to Tuesday, consumer confidence is released, and you have a beat, a substantial beat nonetheless. And what happens? The market's craters. So what the hell is going on? Well, I can tell you what's going on. It's like a methadone clinic. You have traders that are waiting for their shot of QE3 every single month, $85 billion, and any threat to that sets them into schizophrenia. Add to the fact that we're going to war again, once again, in another country we have no business being in. You have the Republicans and Democrats, and I always say there is no difference anymore, in locking arms. Peter King out of New York, my home state, and Barack Obama locking arms saying, let's go to war in Syria. It's not their kids. What the hell do they care? There's only one problem. This is not Libya. You have the Russians that one of their few ports, their warm water ports in the Mediterranean is where? In Syria. Add to which you have the Iranians now threatening to launch missiles at the Israelis. This has a potential to flare up. So let's take a look at the charts. Dow Industrials daily chart, big candlestick. We broke down below last week's low of 14,900. We're coming down here to 14,55127 last seen in June. That's where we're going. Slow stochastics, which I told my members over the weekend, watch for these. They're probably going to roll over. Sure enough, they're forming. They're setting up. The Dow transports, for those Dow theorists out there, this is a weekly chart. And I think it's important to take a look at the weekly chart due to the fact that 62.95 is critical support. If we break down below 62.95, we're going to see 6,000 on the transports. That'll bring the Dow Jones down to our target price. S&P 500 on a daily basis sliced through last week's support at 1640 like a hot knife through butter. Closed below our 50-day moving average. Slow Stokes, very similar to the Dow Jones, rolling over. Let's move on. IWM. I've been bearish on IWM for quite some time now, and we are threatening to take out the 159 level. We didn't close there. We did trade below it. That was the lows we saw earlier in the month. If we take out $100.59 on IWM, for those who are not familiar, IWM is the ETF for the Russell 2000. We are coming down to $99 per share on IWM. Volume spiked through the roof today. Distribution. Slow stochastic rolled right over. And take a look at this. This is where we were forecasting a breakdown in the overall markets here. This is when our signals began to really tell us that this rally was weak and it would not hold up. And here you have your head and shoulders formation on IWM. Left shoulder, head, right shoulder, neckline. We attempted to take out that neckline yesterday to close above it. We failed. And today, a gap down. Not very pretty. XLF, the banks, down 3% so far this week alone. A horrible, horrible week, assuming we close there. And I pointed this out to my members over the weekend in the week ahead commentary. Check out your head and shoulders formation. Left shoulder, head, right shoulder on ADX. Very, very mature stochastics. Expect lower lows on XLF, which is the financials. The semis, SMH. trending down on your ultimate oscillator. Thus far this week, we're down over 2%. There's nothing about this chart that I like. Avoid the semis like the plague. Okay, retail holders. The retailers. This is a daily chart. And you could see RSI just rolled right over. There wasn't much hope for this sector. We couldn't even rally up to the upper band of the rising uptrend channel. It topped out here at 56.05. Head and shoulders set up. Left shoulder head, right shoulders, neckline, boom, gapped right down. It attempted last week to try to rally above the prior lower band of the rising uptrend channel. Topping tail action. I told my members over the weekend, don't touch the retailers. If anything there is short, what happened? Boom. Breakdown on the retailers. So far this week, well, this is a daily chart, 1.47% on a daily basis. Where are we on a weekly basis? 1.73% down on the week so far. It's only Tuesday. XLK, the technology sector. This is one I had held out hope for as a long anyway. Not that I'm long of it. There's one that we might want to get long. And why is that? Well, being that it's a monthly chart and I see resistance levels get taken out, like we saw earlier this month, I become bullish. It's a monthly chart. Yet, what does it appear that we're doing right now? It appears that $32 per share, which has been resistance for 4 months now, we've given up that support level. And now it looks like we're going to threaten to break back down in this trading range between 26.25 and say 31.75. Not a pretty chart. And if it does break down and close below this resistance level, currently support, well, that's going to be a breakout point failure. And I'm going to want to avoid technology. And if technology goes, forget about it. Check out your slow stochastics, choppy action. Members know, don't touch stocks with choppy action. I had held out some hope on money flow because it was breaking out. Again, weekly chart, this is going to be slow to react to today's down volume, but money flow still looks good. I expect that to change in short order. As a matter of fact, let's drill down to a weekly chart, see where we stand so far this week. And here you have it. Here's the tail of the tape, folks. Lower highs on RSI, very, very mature slow stochastics, all rolling over, lower highs. We took out last week's lows. As a matter of fact, it appears that we took out last month's lows as well. Too early to talk about volume. Very, very choppy action. So the markets were forecasting this in advance. I always stress this to my members. Watch out for choppy action, especially on your weekly stochastics and Stoch RSI. Watch out for it because it's a harbinger of bad news. MACD has gone negative this week. Money flow, not looking good. So XLK, the technology sector, avoid it. XLU, bottoming here a little bit of topping action, $37 per share. This is a weekly chart. Lower highs on ultimate oscillator, choppy action on Stoch RSI. Look at this. Lower high on slow stochastic. Avoid the utilities. Think about it, folks. If you're looking for dividend yield on the XLU, is it worth the net asset value, that dividend? Is it worth the depreciation of net asset value from $41 per share down to, round it down to 37, let's round it down to 38. I mean, that's a big loss in net asset value. Is your dividend worth the risk that you're taking for a ETF that appears to be, and a sector that appears to be breaking down? The housing sector, you can check my past stock twits on this sector. Ben Bernanke should resign effective immediately. From 210 to 168 on the HGX, the Philadelphia Housing Index, is a 20% correction. That puts us into bear market territory. Thank you, Ben. $85 billion per month. What did it get us? Nothing. We're in a bear market on housing. The VIX weekly chart, looking good. We broke out above last week's highs. Probability of us hitting 18, which is the next resistance level, is fairly good. Keep an eye. You have a W formation setting up here, 2191 being the pivot point. We get a breakout above that on the VIX. Expect higher highs on the VIX. bond prices on a weekly basis. This is the reason why the utilities are holding in there. It's because bonds is a flight to safety. This is the war concern, and this is where money flows still benefit the United States. Half of the emerging market world is really in a huge decline, especially in Asia, Indonesia. Countries like that are just simply getting hammered. India, getting hammered. And then you add to it the fact that there's going to be a war in the Middle East. There's a flight to safety in bonds. Again, a weekly chart. And what does that do to yields? We'll skirt over to the chart of the 10-year Treasury. Yield, not the price, but the yield. Weekly chart. We're down almost 4% this week. Ben Bernanke is loving Barack Obama right now due to the fact that he doesn't have to do anything. As long as Barack goes to war, there's going to be a flight into treasuries. It's going to supplement the Federal Reserve. If and when they do try to stop their buying of treasuries, it'll keep yields lower because there's a flight to safety. So Barack Obama and Ben Bernanke are out right now. They're drinking beers on the golf course up in Martha's Vineyard, having a great old time. And this is why you're seeing the utilities hang in there. The U.S. dollar, weekly chart, of course, it's going to benefit. You're going to have fund flows coming into the U.S. dollar. The first cruise missile hits Syria. You can expect a spike in the U.S. dollar. Believe me, the currency traders already know it. The Baltic Dry Sea Index on a weekly basis, holding in there. If there's a war in the Middle East, you're damn right that you're going to have shipping rates go higher. So the dry bulk shippers should do okay. And that's it, folks. Folks, the new website is going up soon. My prices are going up from current $29.95 to $49.95 per month. You get discounts for annual rates, but they're going up. So if you want to join the 14-day free trial offer, you've been hanging on, waiting to see whether or not you want to join, this might be your time right now. 14-day free trial offer. It's not for you. Simply cancel. That's it, folks. Have a great, great trading day. Good luck with this market. Be very, very careful. We're coming into some really volatile times.